I'm going to show you quickly and easily how to work out return on investment on a buy-to-let property. We'll also look at yield if you have a rental property, and we'll also look at what costs that you should be considering when working out those two figures. There are a few different ways to work out different figures to stack up a deal when it comes to property investing and buy-to-let property in the UK. And if you understand how to work out return on investment and yield, then you are already ahead of 50 or 60% of property investors who shockingly don't run their numbers. By using these calculations, you're showing very good business sense, risk management, and financial understanding. You'll also be able to better protect your money to ensure that when you're looking at purchasing a property or going for a viewing, you know exactly how much the property costs, how much it's going to need to refurb it, and then what your return is going to be off the back of that. And that is going to help you understand whether you should be making an offer or not. To save you going through the whole video, I'll give you the calculation up front at the start of the video, and then if you want to stick around afterwards, we can look into some of the more details around costs and what to include. Return on investment is the annual profit, so that's your income minus your costs, divided by the initial money that you put into the asset. If you use all cash to purchase a property, then yield and return on investment are going to be exactly the same because you're using all of your money. So ROI really only comes into effect when you're using a mortgage, and that's because a large portion of that money isn't yours. So let's put this into a live example. So let's say your annual rent in a single year is £7,000, and then your annual costs are £2,000. Therefore, your profit from the rent is £5,000 in a year. And then let's say you purchase this property for £100,000 at a 25% loan to value. This means that the mortgage is £75,000 and your deposit or your money that you put in is £25,000. Now, because your profit is £5,000 a year, you take your profit, which is the £5,000, and then divide that by the £25,000 that you initially put in. This means that you have a 20% ROI. So if I invested £25,000 and I was making £5,000 profit every single year, then that means that it's going to take 5 years to earn all of that back, essentially doubling your money. Before we get into the detail, if you're new here, my name's Matt and I invest in property on the side. Please hit the like button for the YouTube algorithm, and if you haven't already, please consider subscribing to the channel for more great videos on property, productivity and tech. So the worst thing that you could do is copy what people do on Homes Under the Hammer. How many times have you watched the programme when someone turns up to an auction, they don't read the legal pack, they have done no due diligence on the property whatsoever, and they've run no numbers and they just bid blindly, not really knowing what the property is worth. Then they underestimate the refurb and then it costs twice as much and they make no money out of the deal. By ensuring that you know the numbers, this means that you know what a property should be selling for, whether that's through an estate agent or through an auction. Therefore, you know not to go over that particular limit, and that's the golden rule. It will also help you with your exit strategies as well. So if you're looking to refurb a property, then what you don't want to be doing is buying a property at market value and then adding a £20,000 refurb on top, because you're not going to sell it for the price that you want. Instead, if a house was worth £100,000 and you're buying it for £60,000, then if you spent 20 on the refurb, you know that you've got about £20,000 in there of profit and manoeuvrability. And that helps you understand from an exit strategy point of view whether you'd want to sell and materialise that profit, or whether you want to refinance and try and pull as much out as possible from the new mortgage, but while also keeping the house at the same time and leaving some or no money in the deal. Aside from ROI or return on investment, we can also look at yield as well. So yield is used when you're renting out a property and will help you understand whether it's good or bad or not. So we're going to look at gross yield and net yield. Gross yield is the total annual rental income divided by the cost, and this is a real quick kind of at a glance number that you can be working out. So let's break that down. So let's say you're making £7,000 a year in rent from a property and the purchase price was £100,000. This would mean that you take the £7,000 and divide it by the 100,000, which gives you a 7% yield, which in the UK, 7% is reasonably healthy. If you can aim for somewhere around 10%, then that's the standard for any kind of asset or investing. If you can make 10% back a year, then you're on good terms. Now, gross yield is good, but it does ignore a few of the hidden costs that come with it. For example, the cost of the mortgage, you might have insurances to pay, general maintenance and voids on the property as well, and that's where our good friend net yield come into play. If you ever get confused around gross and net, the best way I remember is that gross is the kind of the everything yuck, kind of like everything's involved, whereas net is when you've fished it all out and you're left with everything that's left after all those costs and all the bits that you don't want. So that begs the last question, which is what cost should you be thinking of and considering when working out your return on investment and your net and gross yield? There is loads of debate in the industry around how return on investment and yield should be calculated. Some people include maintenance voids, some people don't include maintenance voids. Some people might not look at particular costs, whereas other people do. So when you're looking at people posting on Instagram or social media or YouTube talking about their deals and their ROI, Just remember that everyone works out their ROI a little bit differently. Another level to this is that everyone has their own idea of what potential tolerances they should be using in their figures. For example, some people might have a 10% management cost and some people might have a 10% maintenance cost. However, some might tweak that and management might be 12% and then the maintenance might be 5%. So this really does vary person by person. There's no hard and fast way to do this. So as you can imagine, this is very subjective. The main thing to remember is that when you're working out this figure, that you should be consistent between working out ROI on different properties. So don't keep changing up the numbers every time you work out a new deal, otherwise the ROI and yield are going to be completely different. So let's look at some of the typical costs that you should include. The mortgage payment should be around 3%. Insurance 1%. If you have a managing agent, then that should be around 10%. Repairs and maintenance another 10%. Voids 5%. And then if you have a leasehold flat, then you should also consider things like service charges and ground rent into that as well. A good investor usually includes a rough percentage for all of those figures when stacking up their costs in a particular deal. One other thing you might want to consider if you include bills or you run a HMO, for example, you also will want to include the bills that come with that and also council tax. I hope you found this video useful. We've covered how to work out return on investment for a buy-to-let property. We've also looked at rental yield, both net and gross, and we've also explored the cost that you should be considering when stacking up your property deals. If you haven't already, please consider subscribing to the channel for more great videos, and please remember to hit the like button for the YouTube algorithm. Thanks for watching, and I'll see you in my next video.